webinar series, a series that is geared towards breaking down complex topics with chosen experts to provide business owners and advisors practical advice in these times of uncertainty. We're lucky to welcome 3 guests today, so switching it up a little bit, spanning from Vancouver to Calgary and up to Edmonton. So you'll get a fulsome Western Canadian perspective on business transition during a pandemic or this pandemic. Okay, so a few administrative notes. If you've been on before, you will have heard this. If you want anonymity through this process, or through the presentation, please change your screen name, as others within the webinar will be able to view your name. If you have any technical difficulties, please send your concerns or questions to the Ask a Question user, and they'll be able to assist you with anything to do with your technical needs. As well as throughout the presentation, if you do have any questions, you can send those questions to the Ask a Question user, and they'll send them along, and hopefully we'll be able to address them throughout the presentation or afterwards. Okay, so to kick things off, and for those who don't know, I'm Kevin Shaw. I'm a Senior Vice President at Renaissance Mergers and Acquisitions. Renaissance is a boutique M&A advisory firm focusing on assisting small to mid-market entrepreneurial clients for all their M&A and corporate finance needs. Generally, this means we deal with clients that are in the revenue range of $5 to $100 million. Our services include helping business owners sell their business, introducing minority shareholders, and then also helping buyers throughout the buying process, assisting with due diligence, quality of earnings, valuation, financial modeling, and of course, negotiating transactions that benefit our clients. Okay, to our guests. So on the webinar today, we have Colin Luke. He's a partner in the Corporate Securities and M&A group at Dentons, and he's based out of Calgary. He's joined by his colleague, Michael Beard, who is a partner and in the corporate group at Dentons, and he is based out of Edmonton. And lastly, we're going to welcome back Axel Christensen, who's Senior Vice President at Renaissance Mergers and Acquisitions. And so the goal here across these 3 experts, everyone listening today will hopefully get some first-hand information on M&A activity, valuation, transaction structuring changes, and a range of legal considerations that are either already in practice or anticipated as the new normal begins to take shape. So good afternoon, gentlemen. So first things first, I was hoping that each of you could give a little 2-minute background on your practice within your respective firms. So maybe I'll throw the ball to Colin to kick us off.
Great, thanks, Kevin. Yes, name's Colin Luke. I'm practicing out of Denton's Calgary office. My particular practice focus is private company, lots of mergers, acquisitions, anything business related. So I'll be reviewing supplier arrangements, customer arrangements, shareholder agreements, basically anything and everything that has to do with business. But a large part of my practice is mergers and acquisitions. A number of my clients are private equity. I've worked on both sides of private equity deals. And so I think pretty well positioned to run through today's webinar. That's about it.
Okay, yeah. I'll kick it over to Michael. Thanks, Colin.
Thanks, guys. So yeah, as Kevin mentioned, Michael Beard, I'm a partner in the Edmonton office of Dentons. My practice is pretty similar to Colin's, actually. It's a bit of a hybrid practice. I do a lot of M&A. I assist companies kind of on a scale of some larger public companies, but it's mostly private company work. And that goes all the way down to drafting shareholder agreements, helping resolve shareholder disputes. I also deal with intellectual property a decent amount, so both for licensor and licensees in those types of relationships. But the bulk of my practice, like Colin, is mergers and acquisitions, both on the sell side and on the buy side.
Perfect. Thank you, Michael. And over to Axel.
Yeah, Axel Christensen. I'm a Senior Vice President with Renaissance Mergers and Acquisitions. Kevin, I think, did already a good job of describing what we do. I'm a transaction lead, so I assist sellers with going through the process of transacting their companies and or helping buyers acquiring businesses in that $5 to $50 million enterprise range.
Perfect. So we have a wide range of expertise, as you can see. And so we have prepared a few questions for, we being me, Renaissance, have prepared a few questions for our guests today. So I want to run through those. And like I said, if you have any questions for those viewing this webinar, please send them through to the Ask a Question user so we can get to them as they might be, specifically related to issues that business owners or advisors like yourselves are facing. So before I jump into the first question, I just want to set the backdrop. So, and the current state of the union. So by many measures, we're in unprecedented times. The economy is headed for a formal recession. And my spin on that is it might even be headed towards a depression. Unemployment is increasing faster than at any time on record. The health of the global community is at risk. Companies are at risk of failing. The governments are printing money freely, and a new normal around us is forming before our eyes. So not to be gloomy, but it's gloomy. So maybe Colin, I'll tap you on the shoulder first. So the first question is, considering that the effects of the pandemic will differ for each industry and for each contractual relationship, do you anticipate buyers and sellers to amend or renegotiate the terms of existing agreements? And if so, what provisions may be relevant?
Yeah, I think in many instances they're going to have to. As they're going through the M&A process, even at the very, very beginning, you start looking at things like exclusivity periods for, negotiating time. And, the whole pandemic has thrown a bit of a monkey wrench into the process. And as a result, things are just going to take longer. Due diligence is going to take longer, generally speaking. Interaction with third parties, that are going to have to be interacted with in order to actually carry out transactions, whether they require getting consents, approvals from government authorities, things like that. So on the exclusivity period and just the negotiating, dates may have to be pushed out. So people might be looking to amend agreements just out of necessity on that part. An interesting thing that might result out of this is, and it's not one that you might initially think, lots of times we contemplate contingent consideration in deals where, we have an ownership group that might be still involved in running the business on a post-closing basis. And lots of times we use contingent considerations with, milestones, economic milestones that would allow us to, once they're achieved, then there's additional consideration that gets paid. And if we're heading into a period of time where everything's going, getting a little bit softer and those milestones are just unrealistic, the motivation on behalf of that management team to continue to do what they do in order to, improve the business, it might be lost. And so, a purchaser might look to revisit that. And it sounds kind of counterintuitive that, we're not going to have to pay these guys anymore because we're not hitting those milestones. But it does take away the possibility that, that takes away the motivation so that maybe the business doesn't do as well. And so it might actually be the purchaser that goes to the sellers and saying, guys, we should revisit these milestones and maybe get some motivation back into that management team to do what they can to improve the business, even during these difficult times. I think, kind of going with the exclusivity, period and things just taking longer, generally speaking. People may have to revisit just what consents are actually going to be really, really important. I know, there's some that will have to be revisited. I know that it's a bit of a changing dynamic as time has gone on here. Things like, the Investment Canada Act, there's been, additional requirements in some cases. And so just out of necessity, in order to comply with law, we may have to, sit down and look at different things between, vendors and purchasers. Let's see. May have to revisit just the ability to actually get funding. It could be going through this time that banking institutions might be a little stickier. They might be taking a harder look at their credit agreements. Things like, material adverse effect or, material adverse change conditions in those types of documents. They might be hanging their hat on that saying, no, we're finding ourselves in that. And so willing to fund the way we have or fund the way that we had first anticipated. So parties may have to revisit that. And then, just maybe termination rights, generally speaking. It may be a good idea for both parties to, is a bit of a risk mitigating approach to taking a hard look at, revisiting whether the parties should have, termination rights. Should they, maybe there should be, break fees, things like that will help them mitigate those types of risks. So, there's a whole slew of things that people could do, and probably should do when they're find themselves in these circumstances. And thankfully, it's not often that this is going to actually come up, because it's a certain stage in the negotiating process where you might actually have signed an agreement and you're pushing towards close. Most deals aren't in that. You're in the negotiation stage on the front end, your pre-LOI or your transaction, like the definitive agreement, or you're on a post-closing, and you're only in this window where these things become really, really problematic, where you actually have a deal signed and you're waiting on conditions to close.
Right. Yeah, I think there's a changing environment, and I'm seeing a lot of what you're talking about right now in terms of buyers reconsidering. Maybe, Axe, I want to bring you into this question quickly. I think what Colin's talking about is obviously the common situation where purchasers are kind of in the driver's seat. And I don't know that I'm seeing the other side of that coin too much, but if you and I have looked at a few defensive industry companies, and so you're sitting there thinking, can terms be brought up or changed maybe by the sellers?
I don't know that the seller's going to be in negotiating driver's seat to be demanding changes to terms that are going to be in their favor. I suspect it's going to be more the case of the buyer is going to be looking to adjust terms. In addition to what Colin was talking about, I think obviously not for contracts that are in place, you can't unilaterally change terms, but ones that are in development, you're going to see pressure from buyers to adjust both value and structure, I think. So, the multiple that somebody's paying pre-COVID is a reflection of the risk they perceive the business is going to generate. You have to think that the perception of risk around those future cash flows has changed to the negative for most companies. And therefore, the multiple that they're going to be willing to pay for that same business has probably changed over a relatively short period of time. So I think you'll see pressure there. And there's going to be a desire to kind of shift some of the risk to the seller through earn-out mechanisms or something like that that's going to be more performance-based. So I think you'll see contracts being adjusted to reflect those two changes.
Great. Mike, anything you want to jump in on here, or should we maybe move to the next question?
I think they did a pretty good job covering it, if you want to hop to the next one.
They did do a pretty good job, although a loaded question. So the next question, Mike, I'll toss this one to you. Does the COVID-19 disruption qualify as material adverse change? So material adverse change, maybe give a quick definition of that. Do you expect to see deals fall through or lawsuits brought about based on the triggering of the material adverse change clauses, or are deals likely to move forward despite the current crisis?
So for the first part of the question, in terms of whether COVID constitutes a material adverse change, I think the answer is probably it depends. That's a common concept that's built into a lot of deals, that if there's a material adverse change or there's a material adverse effect, either the purchaser or the vendor doesn't have to go through with the deal. And what the actual definition of material adverse change or material adverse effect is, that's a negotiated provision or term that can vary deal to deal. So very broadly speaking, basically if there is an event, whether it is of a global scale or if it's a more local scale, that has a unforeseen adverse effect on the target company, that's typically what qualifies as a material adverse effect. And that's what can trigger these rights of either the purchaser or the vendor. In terms of analyzing the COVID effect on this, it can be a little complicated because, and again, the wording will be specific deal to deal, but broadly speaking, there's usually a carve out for material adverse effect if you're talking about an event that affects the entire world or the entire industry equally. So what you typically see as an exception to this carve out is if you have a broad sweeping event that disproportionately affects the target company or the target company in question, that's what is going to trigger a material adverse effect. Now, again, it's too early to have a lot of case law or really any precedent on how courts are going to look at this. So again, it's going to be very deal specific, and whether people start to back out or not, I think, again, will depend kind of on the facts of the deal. It certainly can be a trigger if someone is looking to get out to try to rely on that clause.
Mm-hmm. And do you think that I mean, we're in a very interesting time, right? So we have deals that are on the go now that have a material adverse change clause that are going to close knowing or having some awareness of COVID, maybe not the full extent. And then there are deals that are going to come about in the future, or ones that have closed maybe just recently. And so do you think it changes across, like your answer, does it change across the type of transaction?
Yeah, exactly. And that's a great distinction. So I think it is different for each one. For something that's already closed, I mean, the deal is closed. It's hard to go back and now try to back out of it based on a material adverse effect if the deal's gone ahead. For a deal where you're in an interim period between either signing and closing, or whether an LOI is being entered into, that's where you're really in this gray area about whether this event is something that disproportionately affects the industry in question. And again, this will depend on the wording of the specific purchase agreement. If you're talking about deals moving forward, it's probably hard to argue now that COVID is a material adverse effect or an unforeseen one anyways, because again, it's out there, everyone is aware of it. So for a buyer or a seller to now try to back out of something based on the effect that COVID's having when it's the most public thing there is right now, I think that's a little bit more questionable.
Right. And that makes sense. And so we just got an interesting question from the crowd, which Colin maybe touches on the first one question that I asked you, but also maybe across to Michael. So I'll ask it now. Do you see any specific pandemic clauses being added to sale purchase agreements that affect the vendors post-close? So I guess to me, material adverse change is maybe more general. And so when you talk about provisions being changed or added, maybe it's too early to say, but do either of you, I don't know who wants to take it, but do you see this coming about?
Yeah, I mean, I think that the pandemic is significant enough that it's a wrinkle that goes through all the business's performance, right? And so it's a question of how you're going to deal with it. And so, obviously there's going to be economic implications. And so it might go to, performance-based provision in trying to determine, what consideration is going to get paid and when. And so you might deal with it economically so that, if the pandemic ends up having adverse, economic consequences to a business, you come up with maybe a more formulaic approach to purchase price determination, and that might be how it's handled on a post-closing basis. I think that was a question, right? Like on post-closing, you've closed, what other provisions might you put in that
Yeah, specifically around a pandemic.
Yeah, but on a post-closing basis. I mean, a lot of it, as far as the vendor is going to be, or the purchaser is going to be concerned, is going to stem from the reps and warranties. And then from a vendor's perspective, what carve-outs are there going to be? So I would expect there's going to be a lot more attention paid to the reps and warranties, and the impact of those reps and warranties that the COVID-19 will have on the business as you run through. So trying to think off the top of my head, when you start looking at, financial statements representing the business or forward-looking statements, budgeting, those types of things, to the extent that there are reps and warranties on that, you're going to want to put your mind, both parties are going to want to put their mind to the extent of those reps, and probably could factor in some COVID specific type language with respect to those types of reps. Mm-hmm. And then of course, depending on how things evolve over the course of time, if that rep, proves to be wrong, well, the vendor ends up having to suffer the consequences. So I think a lot of it would be in the reps. There might be carve outs. I can see a vendor specifically saying, other than in relation to, the pandemic, all of this is going to be true, but, like having a carve out with respect to this so that they stay on side their reps. So I think the answer is, there will be provisions that find their way in there that are a little bit, have a different spin on them as a result of the pandemic in order to try, address, a whole slew of concerns. But I think they're probably going to find their way in the reps, especially when you're looking at a post-closing basis, because that's what the reps are for, is to protect the party on a post-closing basis so that they have some confidence that what they're buying is actually what they're getting, or what they think they're buying is what they're actually getting.
Right. Okay. Mike, anything you want to follow on there? Maybe if you're thinking about pre-closing?
Yeah, I mean, just what I might add is what you see in a lot of these agreements as well is there's some sort of transition services agreement where the vendor or part of the management team has post-closing obligations in terms of assisting the business or helping the transition, basically. So if you have those types of obligations in place, you might want to consider, one, whether there are force majeure provisions that apply to those post-closing obligations, and then two, if you're going to have those provisions specifically contemplating COVID in those provisions in a more detailed manner, so you can accurately assess whether the vendor or the management team is living up to the obligations that they have and whether they're excused out of them based on certain COVID events.
Right. No, good distinction. Okay, thanks, Mike. Thanks, Colin. We had a follow-on question. Do you see any agreements being signed right now? I guess we're making the assumption that deals are getting done right now, right, guys? No?
Yes.
I think everything from our perspective, I know that pause is a big word with respect to our current transactions, but volume's picking up. And so maybe I want to bring Axel in now. Ax, we're going to talk about valuation from the corporate finance side, and then I'd love to get Colin and Michael's perspective from the term side, legal side. So what is happening? What's going to happen to valuations now? What's happening in the future? Do you think they're going to return? Like you talk about public markets, people say they're going to return to a high. What are your thoughts?
Yeah, I think from over the near term, I think it's going to be very hard to say that there's not going to be downward pressure on valuation multiples. You've got an uncertainty discount, right? The world's a lot more dangerous right now, or at least it's certainly perceived as a lot more dangerous, and future cash flows are a lot harder to predict. So that'll put downward pressure on multiples. There's less buyers out there. Buyers are tending to the fires in their existing portfolio, or they're just taking a wait and see approach. So there's less money chasing deals. There's certainly less financing. I mean, the banks undoubtedly are going to get a little bit more conservative in this environment, given that they're nurturing weakness in their existing portfolio. That doesn't speak to a robust lending environment. And so M&A ebbs and flows in step with capital availability, so that will take the bloom off the rose from a value perspective. And you're going to see, I think, a vast majority company with declining results. So that's also going to tie into declining value. When you've got increasing results or growing results trend, you're pushing up multiples, and it works similarly in reverse when results are declining. So I think the exceptions to that rule will be the counter cyclicals. Like we've got a couple of clients right now that are bucking the trend. One is up 20-25% year over year in March and April. So they're truly benefiting from the COVID environment. And the processes that we're going through right now, those are robust, if not even better uptake than a typical process. Even though you've got less money out in the marketplace chasing deals, it's concentrating on those types of opportunities. So I think value is going to at least be stable for that type of business. Where we go from here really depends on where the recovery goes. If we get a V-shaped bounce back, we can normalize around that. We can treat it like the stock market seems to be treating it. That was a speed bump. Can't even barely remember that COVID thing, onward and upward. Stock market's up over the last 12 months now already with the bounce back it's enjoyed. So if it's a very short defined downturn and it bounces straight back up, I don't think there's going to be material impact on longer term valuations. I think the more likely outcomes is going to be a slow, L-shaped, U-shaped, whatever you want to call it, recovery. And where, more than 1 or 2 years of future earnings are in question because of the slow recovery, you're going to see a longer term impact on value for a vast majority of companies. Again, the countercyclicals being exempted from that.
Right. Yeah, and I guess that's what I was thinking earlier with my first comment, that countercyclical company I was lucky enough to be chatting with an owner of a large grocery chain just recently, and they said each week is their best week on record, and the grocery chain's been around for some 80 odd years. So definitely an interesting environment when you talk about buyers chasing good deals, right? Yeah. So Michael, in our correspondence, you mentioned or you brought up the greater disconnect between sellers and buyers, and so my question to you would be, what can we do to bridge that gap from a legal perspective, or maybe more directly, and Colin, you can jump in on this piece maybe after Michael, but what are you seeing specifically right now with respect to the change in those terms?
Yeah, so there are a couple things. As you mentioned before, I haven't seen a lot specifically actually be entered into yet. It's kind of more of a pause area for me right now. In terms of bridging that gap, probably the easiest thing to do is an increased reliance on earnout payments. So an earnout is any part of your purchase price. You've got your upfront payment on closing, and then you can have post-closing payments. So with earnouts, you can have basically a specific formula in the purchase agreement as part of the deal, along with certain financial milestones that the business needs to hit. And then 6 months, 1 year, 2 years post-closing, whatever the parties agree upon, you can evaluate those milestones. You can basically plug the numbers into the formula, and then you can determine whether the vendor is getting all of their earnout payments or they're getting a portion of their earnout payments. So in this uncertain environment, there's probably some value to backloading the earnout, so to speak, where the buyer can get a little bit of comfort that if this business doesn't actually live up to what the seller is advertising it as, then they're not going to have to pay the whole purchase price. And the seller, on the other hand, if they're confident that their business is going to continue to perform, can get that higher purchase price. They're just not going to get the payments until the business actually has performed. Another aspect is probably escrow and holdback. So in any deal, you'll have a portion of the payment be held back, typically as a holdback, as security for the indemnification obligations of the vendor, security for working capital adjustments as well. So again, in these uncertain times, there will probably be a push to have one, larger amounts held in escrow, and then two, the escrow period to be for a longer period of time.
Right. And do you have a general sense of percentages and how they might be changing, either Colin or Michael? A percentage of purchase price, I guess I'm referring to, and how that dynamic might be changing on deals?
I haven't seen anything specifically. I mean, I can hazard a guess, but it won't necessarily be based on any hard facts. I mean, if you usually see holdbacks of 10 to 25%, maybe up to 20 to 40 earnout payments, I often see 15 to 30% maybe, again, depending on the industry, depending on the deal, and maybe you see that go up to 30 to 40. But again, I'm more pulling these numbers out of, I'm speculating more than anything else.
Mm-hmm.
I think it's, I think a lot of it has to do with, the size of the deal, the nature of the deal, the assets being acquired, and ultimately that all plays out. I mean, generally speaking, your holdback amounts and, even just your indemnity thresholds and things like that, in large part depend on the size of the deal. The smaller the deal, the larger the percentage of these types of, holdbacks, for example. I think that, generally speaking though, across the board, whatever was kind of typical and market previously, just across the board is probably just going to go up. And it's more just to deal with the uncertainty. And, because people aren't going to have the same level of confidence in, say, the performance of the business and the reps that are associated with that. They may not have the same comfort in, in any other kind of purchase price adjustments, where you have like a working capital adjustment, which is very common in transactions. And you're looking at a historical average of working capital requirements going back a year or 2 years. Well, we've kind of got a bit of a blip here where what we are experiencing isn't anywhere near the norm. So what are the working capital requirements, and what's going to be left in the business? Let's say you're buying an actual company. What working capital will be there when we come to the closing date? And there may be a significant different disagreement on what is there. And so in order to deal with that exposure, there's just a large proportion that gets stuck in a holdback to deal with it.
Yeah, that makes a lot of sense. And so I guess my follow-on question would be, and anyone here can pick it up, Axel included, would be if you're going to be deferring or pushing some of that risk back on the vendor, let's say by way of an earnout, so a performance-based form of payment, then should there be more upside for vendors in that case than maybe they would have typically seen before? So if they hit it, they get some other type of bonus.
Well, I can jump on that. I'd say in a normal environment, whenever somebody's trying to push a bit of an earnout onto a vendor, then it would make sense that there's a bit of a quid pro quo and you try and get something to offset that. In this environment, I think they're introducing that to offset which is already a setback in terms of the market environment. And so it's almost as though the weak market environment is a weakness the vendor has already put to the table. And now the buyer is offsetting that with that earnout. So I don't know that the seller is going to be in much of a position to now negotiate something on top of that in exchange.
Mm-hmm.
What they're getting is a transaction in the weaker environment.
Mm-hmm. Yeah, that makes sense. And then, so one question from the crowd, maybe Axe, but I'm sure Colin and Michael have some input here. How will the subsidies being received impact valuation, or at least the perceived risk going into a company? So I guess there's many different subsidies, and the user wasn't being specific, but it's muting the downward effect of the results potentially. So how do you think that plays out?
I'd love to have our valuation specialist on this call, but I think my initial view would be that would be viewed as a non-recurring item. So it's a one-time thing. It's not anything related to the operations of the business. So realistically, from a value perspective, you'd normalize that out. Mm-hmm. It's great that it's there to get them through a rough patch, but it's not something that a buyer is going to pay for because it's not going to be there in perpetuity.
Right.
Well, who knows? Because right now it's not.
Yeah, and I think as I voiced the question, I think it probably falls back on what type of recovery are we in, right? Is it a quick recovery? Is it a long recovery? And that future information we don't have.
Yeah, I mean, for example, we don't back out SHRED because that's a program that's been there forever, and it's super unlikely that that's going to go away. So we don't penalize technology companies or others that have that revenue showing. But because all these subsidies are presumably very short-term in nature, I don't think that's going to impact valuations favorably.
Perfect. Okay. Thank you, everybody. Okay, so we're gonna jump onto the next question, but I'm sure there's going to continue to be some overlap. So please, as you have insightful comment, jump in. Colin, this one's for you. So considering the level of uncertainty surrounding the effect of the pandemic moving forward, how might buyers and sellers mitigate and apportion the business risk?
Well, we've already covered a few ways of doing that. We've got the managing the valuation gap that Michael was talking about, just by way of earnouts, contingent consideration. So you can allocate risk there by putting off what the ultimate value is for the business until such time as you've got some clear visibility and some hurdles that have been achieved. So you can valuation risk can be handled through that kind of contingent consideration process. We did talk about the use of holdbacks, escrows, probably going to have those a little larger than typical, and probably the duration that they're held will be a little bit longer. Again, a way to manage risk and uncertainty in this environment. So those two things, we've talked about and would be good ways to do that. Potential purchasers, I think, and vendors are going to probably struggle for a little while to actually find funding to the extent that these transactions aren't self-funded. And so, they may be, it may turn out that they are actually have to go to a few sources of funding. Maybe they have to do an equity raise, go to a few different alternative lending institutions, things like that, to kind of spread the risk in order to get a deal done. So, I guess in that regard, it's going to be interesting to see what happens as far as, vendor finance deals where we have like a vendor take back finance. It's always an interesting conversation in any event when, a vendor is offering to finance and then, wants a whole bunch of security. And then the purchaser's first question is always, well, are you suggesting that the business can't support the vendor take financing? And that's going to be a real issue here because, who knows, and it goes back to the question, what kind of recovery do we have? Is it going to snap back or is it going to be a little more protracted? And, what does that look back? And so it'll look like, going forward, especially when you're relying on a vendor to provide some financing to get the deal done. So vendors might not be as willing to make that happen. They may not have any choice, but the parties might actively, proactively go out and try to find some other arrangements in addition to just vendor financing in order to get the deal done, just to spread the risk on that piece. Parties, I guess, could consider rep and warranty insurance in order to spread the risk. Mm-hmm. That's something, I don't know, Michael, what your experience has been. I think probably Canada's a little slower to the uptake on that type of insurance. To backstop reps and warranties in an agreement as compared to the States, and probably, other provinces are a little more familiar with handling those types of transactions. I think Western Canada and Alberta is a little slower on the uptake than other jurisdictions, but that is a possibility. You've got your underwriting expenses and you've got, it's costly. And so, but it is a way, especially if you're dealing with parties that, a vendor who, questioning how, what their financial wherewithal is and their ability to actually make good on indemnity obligations under an agreement. Rep and warranty insurance might be available to curb that risk a little bit, maybe. What else? One thing to actually consider, just right now in the short term, is courthouses. They're locked up. They're only handling emergency type things, and so if you're looking through an agreement and you're looking to for some kind of remedy and some kind of recourse, and typically you'd be going to the courts to get that, they're not handling a whole bunch. And so parties should really consider having an alternative, arbitration type process, something that they could actually access in the event that they needed some kind of dispute resolved. And that's, I think, would fall into the risk mitigation category. And I think just generally speaking, parties are just going to have to be, pretty flexible. You get into these deals and you have these interim periods between signing and closing, and there's always these obligations to run businesses in the ordinary course on the part of the vendor. And the pandemic has thrown a bunch of curveballs, at potential sellers here, and they've had to do different things out of the ordinary course in order to deal with the things that are flying at them. And so those types of obligations in the agreement, I just think that there has to be increased dialogue between vendors and purchasers. And you could see situations where just a tighter definition about what ordinary course is, and have some parameters, maybe some dollar values around certain decisions, and then ultimately that might require going to purchasers in order to get their blessing to take certain things on in that interim period. So, another way to kind of mitigate risks between the parties.
Yeah, no, those are fantastic, actually, I would say, pieces of advice. I think practical. you're talking about the arbitration process. Yeah, like practically speaking, we're going to have to maybe outline this a little bit further in a purchase agreement should we enter into a situation that neither of us are anticipating, right? So I think that's a great piece of advice that hopefully some of the listeners are taking away. And so I guess generally what I'm hearing is the environment may be shifting a bit more in favor of the buyers. Favor being, a portion of the risk is getting shifted to the seller. So a short question would be, Axel, is this a good time to buy a business? Or what are you hearing from buyers?
Yeah, I think there's a window of opportunity for buyers over the near term. And I think buyers are realizing this. Like, as you touched on earlier, we've been approached by more buyers and buyer groups in the last few weeks than we have in the prior few years. It's definitely been a seller's market, and I think buyers are sensing that has shifted. How long that's the case really, again, depends on how quickly this recovery takes to roll out. But I think there's a window of opportunity. There are going to be folks out there that have to sell. So if you were looking to pick up some assets or pick up staff, there may be opportunities there. We're starting to hear from folks that don't necessarily have to sell, but they're in the baby boomer category. They're maybe 70 plus now, and they just don't have the gas in the tank or the desire to go through another rebuilding process. So they may be open to selling, even though value is not where it was a few months back. So I think there are going to be opportunities for buyers. The caveat being that you don't want the buyer to be, as a buyer, you don't want to be catching a falling knife. You have to be very careful in this environment. That means more due diligence, longer due diligence, as people have touched on. You're going to have to dig into things that maybe you could take for granted previously. So like the client base, are all those clients going to be there 2 or 3 months from now? Supply chain, how healthy is that? Are key suppliers going to be there? Capital availability, is their lender going to continue to support this business in the same way it's supported previously? So I think there's opportunity out there, but you have to be cautious.
Right. And we actually received a question from the audience. So maybe this speaks to one of those buckets, Axel. What, if anything, are you hearing from older entrepreneurs who may have been prepping for sale and are now confronted by this disruptive event?
Yes, some are putting out fires, so they're not for sale for sure. They've got serious issues in their business and they're off. Others are still intent on maximizing value, and for most of them, they've kind of rightly identified that selling right now is probably not going to do that for them unless they're strongly countercyclical. But then we've got this growing group that we didn't see at the last recession, that were probably 60 or so at the time of the last recession. They built the business back up, but now they're 70 plus, and now they've been hit one more time. And that group is now saying, I think it's time to get out. I want to sell to somebody that can look after my business, look after my people. Maximizing my dollar value is no longer the consideration. A lot of these folks are wealthy outside of the business already, and so they're just looking for an exit. So that's a group that's, I think, early signs are that that's a bigger group this time around than it was at the time of the last recession.
Yes, yeah, I would echo that. Okay, so then you're confirming what I'm hearing here, shifting to that buyer's environment, proceed cautiously, but there could be an opportunity here. There is a group of entrepreneurs that's going to be forced to sell or doesn't have the stamina to push through this pandemic and see the other side, the prosperous other side. So Mike, this question is for you then. As it is a buyer's environment, what considerations should sellers be taking into account if they're presented with these proposals, adding promissory notes, earnouts, that sort of thing?
Yeah, that's a good question. So you might see an increased push from buyers due to the market to structure the payment arrangements as a vendor take back, as a promissory note, something like that, where again the actual payment obligations are deferred. So in those types of arrangements, basically the vendor is becoming a creditor of the purchaser. So the vendor needs to carefully consider the purchaser's credit worthiness in the market in the uncertain times we're in going forward. And part of that will be, Colin touched on this before, but a lot of the time the purchaser's ability to repay in these situations is dependent on how well the target business itself is doing. So vendors who are selling a business that they are quite confident in moving forward should be more confident in accepting those types of payment relationships than vendors who are maybe a bit more worried about how their business is going to do in the coming years. The other thing that vendors might want to consider is the type of security that they're getting. So in addition to a general security agreement over all the assets of the company, in addition to a share pledge in respect of the shares that are actually being sold, they might want to push for a guarantee from either an individual associated with the purchaser or an affiliated company of the purchaser, if maybe that affiliate is a little bit more financially sturdy than the purchaser itself. Pre-COVID, that can be a bit of an ask depending on the deal. It may be a little bit more of a reasonable ask now, considering the uncertain economic times that we're entering into. And it's important to remember too that it doesn't need to be an all or nothing proposition. So if an individual or an affiliated entity isn't willing to guarantee all of the payment obligations, they may be willing to guarantee a portion of them, which from the vendor's point of view is better than nothing.
Right. So even though you may be giving up some of that cash on close, do your best to still protect whatever it is, the consideration that is coming across the table. And it sounds like, batting around the idea of different types of security might still be on the table.
Yeah, I think so.
Okay. Colin, anything you want to add on that piece?
No, nice job, Mike.
Great. Okay. So what I want to jump into next is a question for Colin. And I think this kind of comes back to Axel's last point around it's a buyer's environment, but proceed with caution. So what unique challenges will parties face when undertaking a due diligence process in light of the pandemic?
Yeah, well, exactly. A purchaser is taking a look at this and they want to go into any transaction with their eyes wide open. And the way they do that is by getting as much information as they can in order to, essentially confirm what their expectations are with respect to the business. And so you look at how parties do that historically and it's a document review, it's face-to-face meetings, it's on-site visits, and, things like that, very in-person type of interaction with the buyer. And given the social distancing measures that have been put into place, those things are now a little more difficult. I mean, you're not reviewing hard copy documents, not looking at originals by any means. Face-to-face meetings are, very, very difficult, especially if you're dealing with a cross-border transaction where you might have a purchaser who's coming in from the States or anywhere else for that matter out of the jurisdiction. And in many respects, the on-site visits are impossible. And so, you take a look at that and you start thinking, well, if we're limited in our ability to do things the way we always have, well, what are we going to do? It's interesting. I had a client, right? It was like middle of March. They had actually flown in from the States on a Sunday in order to start doing a week-long due diligence session in person. And by Monday morning at 8:00, they were back on a plane because they're fleeing the country so that they could get across before the border closed. And at one point, we were actually looking at rentals for them so they could drive across the state line and fly out of Kalispell. So, you look at the challenges from that perspective and they're real. And so, I think people are going to, in light of that, I think people are probably going to be relying on forums like this, for the import, the instead of in person, the face-to-face, we're going to be relying on online platforms. I think there'll be additional reliance on local service providers, third-party local, service providers. So, it'll be your advisors, groups like, Renaissance and law firms and accountants and even, business valuators and, places like, auction, like Ritchie Brothers, they'll send evaluators out to look at equipment, things like just, getting people that happen to be locally in order to do some of the due diligence that you would, you typically may be doing in-house and jumping on a plane to go do. So, I think that's one of the challenges and maybe possibly some of the ways that it could be met. I think Axel had mentioned supply chain. We're going to be spending a whole lot more time, doing a much deeper dive, I think, in seeing what the financial viability of suppliers and customers. I mean, if you don't have suppliers and customers, you don't have a business. And if they're changing dramatically, well, you need to get a handle on that. So I think that's, going to be top of mind. And in part, when we do that deeper dive, it's going to be, contractual review, looking at things like force majeure clauses, the ability for, customers and suppliers to suspend the performance of contracts, put off payments, terminate contracts given the circumstances that we're in, things that, you don't really think about. You think about them. These are all things you do think about, but not in light of a COVID situation where we've all got this, artificial restriction on trade by virtue of, just the policies and regulations that are being put in by government that are artificially kind of suspending the ability of people to do business. It's not a natural state of things. So supply chain is important. And then I think just the type of information that we might be requesting is going to be a little bit different. Things like, asking a seller, do you have any public health orders that affect your business? Do you have revised financial forecasts? Have you entered in any discussions with, your creditors, your banks, your landlords, CRA, about postponing payments, and taking advantage of government programs and things like that, are all important and taking up on Axel's point earlier, they're probably one-time expenditures that you're not factoring into your valuation, but there's still things you need to understand and know what the business has done in light of the pandemic and what they're doing to deal with it. What are they doing with their employees? That they have layoffs, things like that. And one of the bigger things, even, and I don't know if I've actually ever looked for it, but people are probably going to have to start paying attention to business interruption insurance policies and whether or not they actually, the company, the target that they're buying has one. And I got to tell you, I don't know if I've dug that deep into a due diligence process to see if they have business interruption insurance, because it's not something that is top of mind, where I think right now it very much is.
Yeah, those are great points. I think that the due diligence process is going to change dramatically, and it probably ties a lot to the provisions statements you were making earlier about change of provisions, what people are going to have to accept moving forward. Who knows how, depending on the type of business that you're in, if you're customer facing at all, you may be forced to have these plexiglass slides and all those types of safety measures, maybe an updated safety policy or hygienic policy for the office or for the retail environment. Who knows, right? So I think those are all really great points. Anything you want to add, Mike or Axel, to the due diligence process, things that you've maybe seen or you anticipate coming down the pipeline?
I guess I'd just follow up and reiterate that the cross-border is an issue, right? With the border closed, a lot of times for us, large U.S. companies are good potential purchasers, and right now they can't come and do a site visit. If we're selling something that's operating, somebody local can certainly come and have a look after hours, cautiously wearing masks and what have you. So you can work around that, but the cross-border is a non-starter for now. The other thing I think will be more challenging will just be forecasting, because realistically, who knows what's going to happen. So it's hard to get a lot of comfort in the forecast right now. And so I think what people are going to have to do is a lot more scenario analysis around their forecasting based on a variety of potential outcomes. And I suspect what they choose to perceive value to be will be some blend of those various scenarios, and that'll have impact on what their working capital forecasting and working capital needs will be as well. So I think all of that's going to be more difficult in this environment.
Okay. Mike, did you want to jump in?
Yeah, just quickly, the only thing that I'd add to increasing the kind of review or the attention that's paid to the insurance is if you've got contracts with key suppliers or vendors, in a business, suddenly the force majeure provisions, if there are any in those contracts, are especially important now.
Right. Okay. Well, I think that's reiterating some of what we've been talking about. So
it's and I think that's the point. I think typically we had an earn out there to incentivize. In some instances where the earn out was there as a bit of a sweetener for a management group potentially to improve the business going forward. So it was a carrot. Sometimes you have that earn out there historically just because the parties just don't agree on what the valuation should be, and you have a vendor saying, well, I think it's worth X, and you have a seller, well, I think it's X minus whatever, and they just can't come to terms, and they say, okay, well, the benefit of hindsight and an earn out, we'll be able to see who was right. And so we have that here. I think what we're facing right now is an iteration of that where neither party really knows what the business is worth, because nobody's got a crystal ball. Mm. And so in order to actually get a deal done, the parties are sitting down going, okay, well, if the future turns out to be, scenario A, this is what the purchase price should be. And the parties go, yeah, I'm okay with that. But if it turns out to be scenario B, this is what the purchase price should be. And the parties go, okay, I'm good with that. I'm good both ways. And it just provides a level of certainty there, in circumstances where it's almost, it's very, very difficult to actually have.
Right. So we have 2 minutes. So maybe what I'd like to do is just closing remarks from everybody. And I can start with Axel's first on my screen here, but just any type of parting remarks with respect to business transition in this COVID world, to leave all of our listeners, buyers, sellers, and advisors with.
Interesting times. Probably has quickly transitioned from a strong seller's market to a buyer's market for the near term. Buyers can have to be cautious in this environment, and how long that persists really depends on what this recovery looks like.
Okay, Mike, how about you?
Yeah, I'll echo that it's certainly interesting times and uncertain times. And a lot of the things that we talked about, I think, will probably develop into trends, but we'll kind of have to wait and see to how the market reacts to a lot of this stuff.
Thanks. Colin?
Yeah, I don't know if I have much more to add. I think everybody's going to be going into this with their eyes wide open. I think that there will be opportunities. But I do think that we're going to have to be a little more inventive in how we actually pursue deals and actually get them closed. So, everyone's going to be different, and we're just going to have to get novel.
Yes. And that's maybe a great note to end on, just because I think we're talking about environments where you have buyers and you have sellers and they want to get the deal closed. And so whether there's more risk going forward or not, which I think we all can agree there is, getting the deal closed is the name of the game. So make sure, for everybody listening, I guess I just want to say first thanks to Colin, Michael, and Axel for joining today. I hope everyone listening took something away from this session, even if it was just one nugget. And if you have any follow-up questions for any of the guests, feel free to reach out to them, or you can reach out to me directly, shooting me an email, kevin@renma.ca. And lastly, stay safe. And if Renaissance or Dentons can be of any assistance, please reach out. Thanks, guys.
Awesome. Thanks, Kevin.
Thanks, everyone.
Thanks, everyone.